Today, we're going to rewind the clock and dive deep into the 2008 financial crisis. But we're not here just to relive the chaos. No, we're going to mine Warren Buffett's shareholder letter from that very year to pull out a timeless playbook, a set of actionable lessons that are, frankly, just as critical for investors today as they were back then. So let's start with a reality check. Negative 9.6%. That was the hit to Berkshire Hathaway's own book value in 2008. Now, sure, the S&P 500 was down a staggering 37%, so Buffett absolutely crushed the market, but the point is he wasn't immune. He was right there in the trenches, feeling the pain with everyone else.
And this quote just captures the feeling perfectly, doesn't it? It wasn't just a market dip. It was absolute sheer chaos. I mean, it paints such a vivid picture of the fear and just the paralysis that took hold of everybody, even the most experienced pros. We were all just small birds in a badminton game. Okay, so that raises the big question. When the entire world is spiraling into chaos, how does a master investor actually behave? This takes us from the storm itself to the bedrock principles that guide Berkshire. What's the foundation that lets you think clearly when almost no one else can? Here they are. Through thick and thin, Buffett and Munger are laser-focused on these 4 things. But the real genius here is what's not on this list. There's no market timing, no complex macro predictions, no obsession with quarterly results. It is all about the fundamentals of the business, and that creates the anchor that lets you act rationally when the storm is raging. And that foundation, well, it isn't just about playing defense. It's actually what allows you to go on offense. And that brings us to the first huge lesson from this playbook, how to look at a total market meltdown not as something to survive, but as a golden opportunity you have to seize. For Buffett, it's really this simple. Widespread pessimism is the ultimate buy signal. It's a flashing green light. It means fear has completely taken over, logic has gone out the window, and fantastic, high-quality businesses are suddenly on the bargain rack. He's not just being a contrarian to be different. He's being a rationalist in a sea of irrationality. And you can really see the two mindsets clashing here. On one side, you have the market, reacting purely on emotion, panicking, glued to the next scary headline, just selling everything. But then you have Buffett, who's operating on a totally different level. He's leaning into that pessimism, guided by that timeless wisdom from Ben Graham: price is just what you pay, value is what you actually get. And look, this wasn't just talk, this was action. Right in the thick of it all, Berkshire put over $14 billion to work. And the key phrase here, the one to really focus on, is unavailable in normal markets. Because they have that fortress-like balance sheet, they could be the lender of last resort, securing incredible deals on terms that just didn't exist a year before. But let's be really clear here. This is not about being a perfect fortune teller. Buffett himself admitted he made a huge mistake buying ConocoPhillips stock right near the peak, a blunder that cost Berkshire billions. So the lesson for any of us isn't about being perfect. It's about having a sound process, a sound philosophy that ensures your big, smart bets will far outweigh the mistakes you're inevitably going to make. Okay, this brings us to the next critical lesson, and it's all about how you define and deal with risk. And believe me, it is a much more sophisticated view than anything you'll find in a finance textbook. And it was right at the heart of the 2008 implosion. Buffett does not mince words on this, does he? I mean, he'd already famously called derivatives financial weapons of mass destruction. And in this letter, he hammers home how they poisoned the entire system, making it nearly impossible to figure out what was really on the books of these huge institutions. They were, without a doubt, a central villain in this whole story. Which, of course, leads to a really fascinating question. If these things are so toxic, why in the world did Berkshire have 251 of them on its own books? It looks like a massive contradiction, right? A classic case of do as I say, not as I do. While the answer is a total masterclass in managing risk. See, Buffett wasn't trading derivatives like everyone else. He was underwriting them, pricing them based on his own common sense view of risk. He structured every single deal so Berkshire got all the cash, the premium, up front. This one move completely eliminated counterparty risk, which was the ticking time bomb that blew up the whole system. He took a weapon of mass destruction and turned it into a bet where he held all the cards. And this observation is it's classic Buffett. It's cynical, it's funny, and it's so incredibly insightful. He saw that because all these banks were tangled up in derivatives, it created this massive moral hazard. The only ones guaranteed a government bailout were the ones whose failure could take down the whole economy. So crazy as it sounds, to be truly safe, you had to become too big to fail. All right, let's pull back for the final big picture theme here. This is all about the fundamental flaw of relying on fancy math over simple, straightforward business logic. A lesson that, well, 2008 taught us all in the most brutal way possible.
To prove his point, Buffett uses this brilliant thought experiment. He asks, what would you charge to sell a 100-year put option on the S&P 500? The standard model, Black-Scholes, the one treated like gospel in finance, says the premium should be about $2.5 million. For a billion-dollar guarantee, that feels incredibly low, doesn't it?
And this chart just puts that absurdity into crystal clear perspective. Over the 20th century, the Dow went from 66 to almost 11,500. And that wasn't luck. That was the raw power of retained earnings and innovation compounding year after year. When you look at that, the odds of the market actually being lower 100 years from now are basically zero. Suddenly, that $2.5 million premium looks completely insane. So, the model is deeply flawed. Black-Scholes relies way too much on historical volatility, basically yesterday's noise. And as Buffett explains with this perfect analogy, using that to predict the future is like letting your manic-depressive neighbor's mood swings every morning dictate what you think your productive farm is worth. It has absolutely nothing to do with the farm's real long-term value. And that brings us to this final, unforgettable piece of advice. This isn't a knock on math. It's a powerful warning against putting blind faith in models that are totally disconnected from common sense and reality. At the end of the day, in a crisis or in calm times, an investor's most powerful tools will always be sound business judgment and a long-term perspective.